tips on considering the right life insurance policy. We're going to go through a couple general bullet points here, and let's start with the right company selection. So there are a lot of insurance companies out there, which you don't need this video or us to tell you that. We can go on Google and type in the word life insurance and see a million advertisements pop up, or just turn the TV on for a little bit. When it comes to cash value life insurance, and just to iterate, this is somewhat aside from the banking concept. The banking concept can work with most cash value life insurance policies. That revolves around borrowing and repaying from a life insurance policy, using it as a financing tool, very similar to a line of credit. But when I put money into a policy, really my goal from the beginning is how do I maximize that monetary value, make sure that the flexibility, the limits, everything is accommodating. I don't want to trigger a MEC, which we're going to get into that. But if I maximize the monetary value of that policy, whether I just let it sit and grow, or if I decide to borrow and repay, use the account for the infinite banking concept, if I've got more money in cash value, well, that's just going to enhance my ability to use that money. I have access to more capital. So the first thing we have here are our four major mutual companies: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. We recommend really to everyone we speak with, regardless if you work with us or not, make sure we are at least considering or asking about these companies. And the reason for this is we have several studies, and we've done several studies, is we have seen consistency as far as actual net returns. They've consistently delivered, not necessarily the dividends. A lot of times people see a company with a high dividend and think they're the best presently, or we see an illustration that projects the strongest numbers and we think that's the way to go. Where it is a projection. Anytime I see a dividend rate, that is a gross dividend rate. We have segments on that. But when I look at the net internal rate of return, what's my end result on my cash value? We have seen consistency with these big four. They've delivered, and when we work with big institutions, whether it's banks, corporations, small businesses that have cash value life insurance, they've had it in the past, they've stress tested things themselves, a consistency we see is they always go back to these guys. There's a reason for that. They've consistently delivered. Now, depending on how much flexibility we want, how we want to actually use the policy, that will have a big impact on our company selection, loan rates, cost of borrowing, all that good stuff. But first, maximizing cash value, we've seen consistent delivery with those four. You can look at some of our historical study videos for proof. Over here, policy design. This is critical. This is more important than the company selection, in my opinion. At the end of the day, when I pay money into a life insurance policy, where can my money go? Two main areas: insurance premium, that's my insurance expense, or it can go towards cash, my PUA rider. Dollars that go towards premium, my insurance expense. First and foremost, those buy me life insurance, a death benefit. Typically, with a traditional policy, I'm going to find in the first year, and often in the first 2 years, depends on the policy and the company, zero or next to nothing of those premium dollars show up on cash value. What the insurance company does with premium dollars, they overcharge me for the death benefit up front. And then my premium dollars start to go to work. I see them show up in cash value. So one thing to clarify is I hear the word premium, I think of my auto insurance policy where I pay it and I hope I never use it. With a life insurance policy, premium dollars, even though we refer to them as insurance expense, I am going to see that build cash value for me. Just those dollars firstly satisfy the death benefit. Then I've got cash contributions, PUA riders. Dollars that go there, we call them cash because they go into cash, start to earn interest right away. And when I say they start to earn interest, that's the guaranteed rate. That's any dividends. That's money I have access to. This is the key to really ramping up the returns in a cash value life insurance policy. And it's the key to giving me more money to practice IBC, to pull money from the account, whatever my goal is, sooner rather than later. Then we have death benefit over here, because cash contributions do purchase me death benefit, just not nearly to the degree that premium dollars do. If I put $1,000 into cash, you might see, depending on my age, a nice average is about $3,000 come back in life insurance. Again, the purpose here is cash value. When we work with banks, if you look at a traditional bank-owned life insurance policy, it functions a lot like a big PUA deposit. If they deposit $10 million into a BOLI contribution, you'll see about 3 times that open death benefit. But all of their deposit, their money, shows up in cash. So a question we get here in relationship to the policy designer, what are my limits? Hey, I don't care about the premium. How do I minimize my insurance expense to zero and put everything into cash? Well, the limits here, one, I have the insurance company. Whatever my total contribution is, or total desired contribution, typically 10% is the minimum. Another way to put that is if I have a $5,000 premium, that'd be my insurance expense, the company will often allow for a total contribution of $50,000, 10 times or 10x that contribution. That's relatively consistent with the Big Four. Smaller carriers sometimes have more flexible, some have less flexible limits. But that 10% is a safe bet to look for, especially in the Big Four, or question it and ask it with their agent and look for proof, actual numbers. Whenever they show us illustrations, that is. And then the IRS. Well, they do have limits on this. The big draw to cash value life insurance is that if I do everything properly, it's tax-free. That's the draw. That's the attraction. Any policy can become classified as this MEC, this modified endowment contract. If it does, the policy is now going to work more similar to a 401k in the sense that it still grows tax deferred, but when I want to access my money, what happens is I have to pay income tax on the gains in addition to a 10% penalty tax if I'm under the age of 59 and a half. So just a couple tips here. To sum it up, company selection, policy design, make sure everything's maximized. Again, if I maximize my monetary value first and foremost, that just gives me more money to have in the account if I just want to sit and let it grow. More money to have in the account if I want to borrow out and invest in real estate, business, stocks, whatever it might be. Hope this helps.